Welcome back. Another week in the books. We're going to jump right into the Bitcoin Macro War Room. I release these every Friday. This one is a little different just because I'm traveling this weekend. So I'm recording this on Wednesday evening, and this will be released Friday morning. So the only thing that I'm going to miss is one data release, but that's not that important. The most important data release did come out this week, which was the ISM Services. And without further ado, let's jump right into it. We're going to start off with my global liquidity tracker and the regime tracker. So as you can see, we still have a huge air gap between where current Bitcoin price is and where global liquidity is. This has now, in my mind, officially decoupled. We are at 21% 30-day correlation. So this nuked. I think last week when I did the video, we were at about 60% correlation. And the week before that, we were correlating 85%. So this has dropped off a cliff. We're still technically risk on for this indicator, but I want to point you to the regime tracker down here in the bottom right. The cycle phase is now switched to expansion, which is really good. You can see the indicator slowly ticking upwards. The two red scores are the ISM delta, because obviously the data came in soft, which we'll get to next, and net liquidity dropped off as well, basically just because of this drop here that you can see. That's pretty much it. Things are still looking good, although we're in kind of a chop zone. If I had to put a label on it, we're in chop zone. We're in this 105 to 120 area, and it's going to take something to move us further up, and we'll see what that ends up being. August is historically not a great month for Bitcoin, but I don't put too much stock into seasonality. To be honest with you, for Bitcoin, there's just not enough data. It works better for stuff like the S&P 500, in my opinion. Whatever. Let's get into the actual data releases for this week. So we'll start off with the only data release. I mean, compared to last week, this was, last week was insane in terms of the amount of data. This week is basically just the ISM Services PMI. And as you can see here, the actual number came in at 50.1, where the forecast was 51.5, and the previous was 50.8. So we actually dropped off. Again, the ISM Services PMI tracks the health of the US services sector. Anything above 50 signals expansion, but now we've come back to basically 50. It's a pulse check on 70% of the US economy that is not manufacturing based. This print obviously was soft, and we'll go into why that's important, because this print being soft means the Fed is late. For Bitcoin, this is the canary in the macro coal mine. The slower the services get, the closer we are to Powell blinking, and it's fuel for the next leg up. But if growth dies too fast, credit cracks widen, and Bitcoin could bleed further before it dips. We've now been in a contraction here for quite a while. I mean, if you look at this chart going all the way back to 2009, you can see where we are now compared to where we've been. Obviously, after the global financial crisis, this was an even crazier chart. We can probably pull it back even further. Yeah, you can see the global financial crisis for 2008. You can see the COVID numbers. And I mean, based on historic averages, we are well below that. So the Fed is late. In my opinion, there's no sort of debate about that. They're just late. And we'll get into what that means, because they didn't cut this month. And if we look at the probabilities, my favorite thing to look at, I remember looking at this last week, and I think it was 80 something. I don't remember. And then when I first started the Macro War Room, it was at about 40 or 50%. As of today, it is 93.6% that they're going to cut in September. So basically a shoo-in that they're going to cut rates. And if you look at October, there's a 64% chance there's going to be a second cut. And then if we look at December, there's a 50% chance of another cut. So the probabilities, my favorite sort of little table here, have shifted heavily towards 3% sort of being the Fed funds rate for middle of 2026. And you can even see for the end of the year for 2026, there's a 25% shot that we'll be at 2% for the Fed funds rate. So this has changed a lot in the last couple of weeks, and that's been super interesting. So take that for what you will. let's go into my actual system. There has been a change here. You can see last week we were risk on 98%. Now we are risk on 103%. We are off the charts in terms of being risk on. Again, all this means, the whole point of my system here is to figure out whether we should be risk on or risk off. And what risk on or risk off means is, should you be fully invested in risk assets, or should you be holding cash and not long? So I've been long. I've been long since I started this show back in July. Nothing has changed. The only actual number that made us go from 98 to 103 was the regime tracker that I showed in the beginning, because it's now signaling expansion and the trend is up. The score moved from 0.5 to 1.0, and that put us at 103% because of how these things are weighted. With that said, we do have a new section for this little Friday show. So before we get into the on-chain indicators, I want to go through some tweets that I found this week, and we'll kind of talk about some of them. We'll see how it goes week by week, if this is interesting for people. Just some things that I thought were worth calling out. So the first one here is from Thomas. Bitcoin's diminishing return between cycle peaks are undeniable, but all models were destroyed by Bitcoin hitting all-time high before the last halving. That's never happened before. Is this time different, or will the diminishing return patterns continue? I really like this take. I don't think people think about this enough. All alpha will decay. There is no going back. You are fighting hedge funds. You are fighting quant models. You are fighting the best mathematics people in the world who are trying to make money in the markets. All alpha decays. You can see this easily by looking something like at the MVRV ratio, Z-score. Every cycle, the peak gets lower, and this will just continue. So I like this take. We'll continue to the next one. This was a great one. CryptoCon always posts really good charts. And basically, as you can see here, we still have room for this cycle. If you're looking at it on this chart, we haven't hit any quote unquote red dots if you look at the bottom indicator. And this is a perfect example of what I was just saying. Let me actually move my camera here so you can see it. All alpha will decay. And you can see it here clearly, even on this chart. Over time, if I could draw a line across this cycle top oscillator, each cycle, the top is getting shorter, meaning shorter on the oscillator, not for the price. So for this cycle, we might barely hit red. We might not hit red at all on this oscillator. So you have to be aware of that. But again, if you enjoy macro charts like I do, CryptoCon is definitely a great follow. Carl B here, the dollar just had its worst start since 1973, and that's rocket fuel for Bitcoin. This is spot on the money. I made an entire video about how Bitcoin and the DXY, or the dollar, are inversely correlated. So go check that out. It's on my channel if it's something that interests you. If you're a serious Bitcoin investor, you should be watching the dollar. A strong dollar is not good for Bitcoin. It's not good for risk assets in general. I wouldn't say 100% of the time, but a majority of the time, it does matter, and it needs to be looked at by anybody who is serious about their portfolio. So we'll continue here. Another great chart by Mags, but something I actually disagree with. So Mags is pointing out that the strategy here is buy Bitcoin 500 days before the halving, do nothing, sell 500 days after the halving. I don't think the halving has that much impact anymore on Bitcoin's price and the cycles. Does it still matter in some sense? Yes, because the supply is less for miners, and that affects other things downstream. But there's institutions now, there's sovereign wealth funds, there's nation states buying Bitcoin. The fact that the reward gets halved is just a sort of symptom. It's not a result, in my opinion. And the main thing to really note for me is that when Bitcoin was released, it coincided with the global financial crisis and the debt refinancing cycle. It just happened to align. So every 4 years, governments need to roll over their debt. That kind of aligns with, quote unquote, the halving cycle, give or take 6 to 18 months. But in my opinion, I wouldn't worry too much about the halving cycles going forward, unless you're really looking at mining metrics, hash rate metrics, things like that, and using that for some sort of system. But either way, a cool chart to look at, and always good alpha somewhere. So I'm gonna show my own post here. This is the over-the-counter OTC addresses balance MSTR, all the strategy funds, all the Bitcoin treasury companies, ETFs, miners, corporate balance sheets, whatever, they bought over 200,000 Bitcoin this year so far. And they do their buys off the market on OTC desks. There's 147 Bitcoin left. You can see on this chart, it has just diminished since 2022. So what happens when this hits zero? That's when the real supply shock will happen. There's arguments against this for sure, but I just thought it was an interesting angle to look at. And that's pretty much it for the tweets. We'll take a look at some of the on-chain indicators to finish this up. And we will start with the inter-exchange flow pulse. Still bearish. What a surprise. This has been the case since I've started this show. It has not turned bullish yet. It's actually more bearish than it was before. We can take a look if we actually zoom into what's going on here. Yeah, it turns bullish when the sort of IFP 90-day MA is crossed by the actual IFP number. So we are still bearish here. This is the only bearish indicator on my system. For the bull bear market cycle indicator, still bullish, and we've come off a little bit. So kind of reset here almost to zero like this last time. MVRV Z-score, bull versus bear market, still healthy, still bullish, nothing to be concerned about here. Sharp ratio has spiked, which was interesting to me. I didn't expect that because the short-term sharp ratio actually declined. MVRV declined, which is good, kind of cooled off. Retail and long-term holder, some changes here, but nothing really to glean from those numbers. Retail investor demand still kind of high, too high for my liking. You want to see retail completely gone. Realized price STH still bullish, which is good. Realized pricing bands, nothing really important there. We have hit the smart DCA zone. So smart DCA is saying if you have capital, if you have cash, these are good prices to buy at. Again, a reminder, this is only to be used in a bull market. You can see in a bear market, it's going to basically signal the entire time. So keep that in mind. And yeah, sharp ratio for the short term has come off a little bit. So that's pretty much it for the on-chain indicators. And that's pretty much it for this week. We can take a look really quick just because I didn't actually see what's going to be happening next week for the data releases. So yeah, some important data. We have CPI, PPI, unemployment, core retail sales, Empire State Manufacturing, and some consumer sentiment and inflation expectations, whatever. So that's pretty much it for this week. As always, if you made it this far, thank you for tuning in. Thanks for being with me here. Thanks for watching. I really appreciate it. You know what to do. I'm not going to ask you for it. If you enjoyed it, do what you got to do. I'll see you again next week and have a great weekend.